Good afternoon, everyone. I'm Fred Murphy. I work with the Marxist Education Project, and we're very happy to be presenting this along with the People's Forum, an event with Scott Aquanno and Steve Maher on their new book, just being published this week by Verso, The Fall and Rise of American Finance. Marxist Education Project has been in existence in New York City since 2014. Our predecessor organizations, the Brecht Forum and the New York Marxist School, the Committee on Marxist Education, go back to the 1970s. So we're very proud and happy to be continuing that tradition. And would just say also that this is the first public on-site event that we've held in New York City since 2020, when we were hit with the pandemic and went online. And we hope to continue presenting public live events in New York from time to time over the next few months. We also have folks joining us today on Zoom and on YouTube. So we hope to have a good discussion with Steve and Scott. They're going to speak for about 40 minutes, and then we'll throw it open for Q&A, comments and questions from the audience, both online and here in person. So turn it over to Scott and Steve.
Thanks very much, Fred. Just like to start off by thanking the Marxist Education Project and the People's Forum for organizing this event and for hosting it. Marxist Education Project does really tremendous work. We've been at the Socialist Register. I'm also the co-editor of the Socialist Register. We've been doing stuff with them for quite a long time, and they really just are fantastic. So thanks to them. Secondly, I'd like to apologize for the fact that we were supposed to have books here, and through no fault of the organizers, there was a crossed wire situation where the books were not received. So we don't have books with us. That they are coming out on Tuesday, so you can just order them from your favorite bookshop, and you'll be able to get them soon enough. Okay, so the book is The Fall and Rise of American Finance, and really what we wanted to do, we had a tremendously great time writing it. It took about 2 years to put together, and really what we wanted to do was to provide a very accessible and non-technical narrative account about how the financial system works, how the system developed over time in the United States, and how finance relates to production, right? The so-called real economy. And in particular, the role of the financial system in the formation and reproduction of class power in American capitalism. Its centrality to the capitalist system, the real economy. And really what we wanted to do was to challenge the idea, which is prevalent on the left and progressive circles more widely, that finance is somehow parasitic on industry, or that the rise of finance comes at the expense of industrial capitalism, causes the hollowing out of industrial capitalism, and is synonymous with the decline of the American empire or with capitalism in the United States, so like a late phase of American capitalism. And instead to really show how finance is deeply interconnected with the real economy. And that actually the rise of finance in the current period since the 1970s has come with and enabled the strengthening of class power, capitalist class power in the United States, and the strengthening and the intensification of the competitiveness of American capitalism, and has created the conditions whereby American multinational corporations have been able to remain the dominant economic institutions on the planet. So we really wanted to kind of push back on this idea that finance is parasitic, and we wanted to do it in a way that is non-technical and accessible, and that makes our arguments in that way. So Scott's going to, we do this by kind of tracing the history of American capitalism from the demise of the finance capital empire of the robber baron J.P. Morgan, all the way to the rise of the big three asset management companies, Blackrock, State Street, and Vanguard, in the contemporary period since the 2008 crisis. So Scott's going to lay out some of that history.
There we go. So we argue that the history of financialization, in fact, has 4 phases. A classical finance capital phase, a managerial phase, a neoliberal phase, and a new finance capital phase, which was constituted after the 2008 financial crisis. And in fact, we have 2 chapters in the book dealing with the new finance capital phase. So these phases form, we argue, a cycle consisting of the gradual decline and then the uneven and contradictory rebuilding of financial power. And the book then is really about the role of finance in the making of American capitalism. So we argue that each phase is characterized by specific organized forms of state power and specific organized forms of corporate and class power. We show that these phases are marked not by sharp breaks, but rather by both continuity and change. Moreover, we show that each phase is kind of punctuated by a major financial crisis, the Great Depression, the profitability crisis, and the 2008 financial crisis, and the resulting process of restructuring by a relatively autonomous U.S. capitalist state. So maybe I'll just take you through the 4 phases of American finance that we chart, and then I'll push it back over to Steve to kind of provide a deeper investigation of some of our core arguments. So the first phase, the classical finance capital phase, roughly lasting from 1880 to 1929, saw ownership and control of industry come to be centered around large investment banks. And of course, this is, the House of Morgan, and above all, therefore, characterized by, J.P. Morgan's web of corporate control. The power of these investment banks hinged on their ability to issue credit, and thus over their vast pool of money capital. In addition, though, their position as the largest stockholders in the economy allowed them to acquire seats on boards of directors and to establish, quote-unquote, interlocking directorates of firms they controlled. The result, we argue, and this argument is not, of course, strictly distinct to us, was a fusion between financial and industrial capital, what Rudolf Hilferding called finance capital. So within this system, financial institutions played an active and direct role in the management of industrial corporations. They shaped the strategic direction and organizational structure of the vast networks of firms they controlled. But critically, the period of classical finance capital was not characterized by financial firms micromanaging the day-to-day operations of industrial firms. This is not what finance capital is about or was about. Rather, it was about financial firms, investment banks, exercising more general, broad control over the network of industrial firms they controlled. So that characterizes the classical finance capital period. And one of the things we also do is chart the development of the Federal Reserve and the emergence of kind of that branch of what we call the economic apparatus of the state, showing the deep integration between the financial sector as it was emerging in the U.S. from the 1880s on, and of course, the central bank. The second period, managerialism, lasted from, we argue, 1930 or so to 1979. And as indicated, this period emerged out of the Great Depression through the regulations enacted by the state in response to the total collapse of the banking system and the economy. These quote-unquote New Deal regulations, as reflected most prominently in the 1933 and 1935 Banking Acts, formally separated banks from the governance of industrial firms, leading to a separation of ownership and control. Those who owned the firm, the shareholders, were now formally different from those who controlled the firm, the managers. Now, this left, we show, inside corporate managers as the preeminent force in the economy. The absence, in other words, of large blocks of shareholders in this period allowed managers to control industrial firms without facing a coherent challenge from outside investors. Separating the banks from industrial corporations, however, led the industrial corporations themselves to actually internalize a range of financial functions and to develop extensive capacities to raise and lend and eventually to allocate capital independently from the financial system. And so we show that the financialization of the non-financial corporation originated not in the neoliberal period, but at the height of the golden age of capitalism in the managerial period. Another argument here is that the hegemony of industrial corporations was supported by what we call a New Deal state. The New Deal state was distinguished by its focus on the legitimation functions, elections, etc., welfare policy. It was also a tax state, in that state fiscal expenditure was substantially relied on taxation. The economic apparatus of the New Deal state was organized around the military-industrial complex, which integrated the most dynamic corporations in the economy with state power. So the process of state-corporate integration, led in turn to huge growth and diversification of corporations, and led to the emergence of the multinational corporation. So what we see here during the managerial period through this process of state integration was the development of what is termed a multi-divisional conglomerate form of corporate organization. So a specific form of corporate organization that is itself increasingly becoming financialized from the inside is the result of the managerial period, which was marked paradoxically by the separation of outside owners and inside managers. However, of course, as union rights and New Deal programs posed barriers to accumulation, we see the emergence of a profit crisis in the 1970s, which is well rehearsed in the literature. This was only resolved, however, through what we call the formation of an authoritarian neoliberal state, as well as the globalization of the economy. The globalization of the economy hinged, of course, on the financialization of the economy. And this brings us, of course, to the neoliberal period, which we chart from, which we see starting from 1980 and lasting until the 2008 financial crisis. During this period, the hegemony of industry was overtaken by a new form of financial power. The return of finance resulted in good part from the integration of global financial markets, which, as I just mentioned, provided the essential infrastructure for corporations to circulate value across internationalized production channels, right? Globalization hinges on financialization. And also the proliferation of worker pension funds beginning in the 1960s and 1970s managed by professional money managers. So what pension funds and the rise of these institutional investment funds do is really concentrate capital, again, in a way that hadn't really been seen since the 1920s. So during the neoliberal period, as a result of these processes, financial institutions came again to wield significant power over industrial firms through a wave of concentration and centralization of corporate stock. This is no longer centrally about credit. Given the profitability of corporations, or the emerging profitability of corporations, again, it's now about more so corporate stock. Yet, in contrast to the classical period of financial hegemony, which I just mentioned, financial firms were exerting not kind of like direct control over firms, but broad structural discipline over the network of firms that they controlled. And we call this a form of polyarctic financial hegemony, again drawing on some of the literature here. So now this neoliberal form of financial hegemony was centered around largely the banks, as well as a new group of institutional investors who held large concentrations of stocks. These institutions were themselves linked to and integrated into and participated in an emerging system of market-based finance. The neoliberal state that supported this configuration of corporate and class power was, I mentioned, fully authoritarian or extremely authoritarian in the liberal democratic sense, of course. And was also a debt state, not a tax state. And this, of course, is drawing on some of Streeck's representation and description of this process. But one of the things we're careful to argue against is that the return of financial hegemony during this period was simply just like imposed by outside investor pressure. Financial hegemony actually initially emerged within the industrial firm itself. Indeed, by the neoliberal period, the general managers of industrial corporations had become themselves finance capitalists. Sitting at the nexus between finance and industry, they were allocating money capital among competing divisions and investment opportunities to maximize profitability. So this period, the neoliberal financial period and the return of financial hegemony that brought, saw its conclusion, we argue, in the 2008 through the 2008 financial crisis, which in many respects was as deep as the Great Depression. The results, of course, and how this played out was very different, in good part because of the state intervention which followed. But the depth of the crisis and the severity of the crisis cannot and should not be underestimated. So what we call the new finance capital period emerged from the 2008 crisis and the state-led restructuring that followed. We argue that we see the formation during this period of what we call a risk state. This itself is based around the development of new institutional capacities inside the state, particularly the Federal Reserve, aimed at managing and making more resilient the market-based financial system which had evolved during the neoliberal period. Right? So this is not some type of state action that is just instrumentally adhering to the will of finance. It's about preserving and protecting and managing an institutionalized system necessary for credit creation during this period. So new finance capital, as the name indicates, marks a new form of fusion between financial and industrial capital, getting us back, of course, to the beginning of the cycle. When what we see during this period is that the diffuse, broad financial power of neoliberal shareholder capitalism gave way to a more centralized and concentrated form of management through giant asset management companies that now exert broad control over industrial capitalism. And in a sense, what we see here really through the rise of these giant asset management firms, Blackrock, Vanguard, and State Street, the big three as we call them, and as others call them in particular, is that the basic trade-off between concentration the basic trade-off whereby investors could either own a relatively small portion of a large number of companies, I always stumble through this, or a large portion of a small number of companies was eliminated. Now what you see is a large portion of companies a large share of companies being owned. Now what you see is large portions of share ownership across a large number of companies. That's the trade-off that I'm referring to in a bit of a fractured and confusing way. So the big three have come to collectively be the largest or the second largest shareholders in firms that comprise 90% of total market capitalization of the U.S. economy. This includes 98% of firms on the S&P 500 index, which tracks, as we know, the largest American companies. And the big three own on average 20% of each of these companies. And the big three, these asset management firms, intervene in these companies in much the same way as the investment banks of J.P. Morgan's days intervened in the companies they controlled. So by pooling, these giant asset companies pooled the massive pools of capital accumulated within pension funds and institutional investors, creating more centralized forms of financial power and gaining a degree of economic dominance unseen since the days of J.P. Morgan. The question of the stability of this new period of finance capital and its uneven and contradictory development is something we deal with in the final chapter of the book. So these are the 4 stages that we chart through the book. And through this kind of this sweeping history of the fall and rise of American finance, we pull out the centrality, the central role that finance plays in American empire and capital accumulation and in facilitating competition amongst a range of other core arguments. And it's those kind of core arguments that bleed throughout the book that Steve will now turn to.
Thanks, Scott. Yeah, so out of that historical narrative, we basically try to make 6 central arguments. The first is that financialization is not new. So it's very commonly the case that you see the argument that financialization is something that's happened since the 1980s. It's a relatively recent feature of a decadent or late stage of capitalism and is therefore easily identified as part of the decline of capitalism. But in fact, what we show is that far from having been just a feature of a relatively late stage of capitalism, finance was utterly integral to the early formation and dynamism of American corporate capitalism. No financialization, no multinational corporation. No financialization, no corporate capitalism at all in the late 19th century, early 20th century. So finance played a central role in the early health, dynamism, development, competitiveness of capitalism and the formation of the corporation itself. Along with that, after the demise of the investment banks following the great crash of 1929, a new form of financialization emerged in the very heart of the post-war golden age of capitalism. So the people who hold up, the many analysts who hold up the golden age of capitalism after World War II as being the defining moment of pre-financialized, supposedly good industrial capitalism, in fact, financialization was taking root at that very moment. And financialization was taking root at that moment because of the contradictions of state regulation. Trying to separate industrial capital from financial capital only resulted in those industrial corporations developing financial capacities that they had to carry out, which used to be carried out by the banks in the previous period, but which they had to facilitate. So there's no pure pre-financialized golden age capitalism. Financialization was a product of the golden age. It took place precisely because of the contradictions of the golden age of capitalism. And precisely as a result of the effort to suppress finance in that period. The second major argument we try to make is that finance and industry are not separate, right? And this comes directly out of the first point, right? The common framing that finance is the cause of bad capitalism, whereas, manufacturing was the good capitalism, manufacturing-dominated capitalism was the good capitalism of the previous period, just doesn't hold, right? These things are always completely intertwined, and the rise of finance actually was part and parcel of the restoration of the health of capitalism coming out of the 1970s, right? Finance was not a problem for capital in the 1970s, getting out of that crisis. It was a solution to that crisis. It restored class power. It strengthened the capitalist class. It opened up the whole global periphery to exploitation by American multinational corporations. It disciplined labor inside of the American social formation. So finance and industry are not separate, and it's impossible, therefore, to identify finance as bad capitalism and industry as good capitalism. And even, least of all today, in the wake of several decades now of globalization, in which the interests and economic processes of finance and industrial sectors are more intertwined than ever, you can't separate the supposed victims of globalization being industrialists and the victimizers being finance, right? It's just their interests are all but indistinguishable today, and globalization has facilitated that. So there's no industrialists who have been victimized by globalization and no financiers who have benefited from globalization. These things are completely interlinked, and they enable each other's health and success. The third argument we try to make is that financialization does not signify the decline of capitalism. And that's apparent from what Scott was just saying. Finance was a solution to the 1970s crisis. But if you look today, it's very common. You see the argument that supposedly investment is low, R&D spending has collapsed, we're in this period of extreme capitalist stagnation. Actually, investment is only low if you look at investment as a proportion of profits or sales. And the reason why it looks low, if you look at it as a percentage of profits, is because profits are very high. And that's partly because of financialization that profits have been restored to such high levels. If you look at investment as a share of GDP, it's exactly consistent with the entire post-war period and is even elevated. So investment has not declined, R&D spending has not declined, they have remained high. Meanwhile, managerial compensation is sky high, profits are sky high. If there's a crisis in the system right now, capitalists would be very interested to hear that, and they would be very surprised, I think, to hear that. Of course, we're all aware that we're living through a massive social crisis, right? There is the crisis of care, as Nancy Fraser has dubbed it. There is huge social issues that are associated with the rise of inequality in the United States in the past couple decades. But that's not a problem for capital, right? Intensified labor exploitation is not a problem for capital. Increasing inequality is not a problem for capital. The immiseration of the working class is not a problem for capital, right? Those are all actually markers of the success of the rebuilding of capitalist class power coming out of the 1970s. So people often identify the social crises we're living through in the United States with the decline of capitalism. But that doesn't track, right? Capitalism is causing those social crises and benefiting from them. The fourth argument we try to make is that financialization is not monopolization. So there's typically this argument we see that capitalism started with a competitive phase, and then over time it became a monopoly system. We entered a monopolistic phase. So this relies on what we might refer to as a quantity theory of competition, right? That as the number of firms declines in a particular sector, competition declines with it, right? So as the economy develops, processes of concentration and centralization of capital identified by Marx mean that the number of firms declines, right? Centralization and concentration, you have a smaller number of larger firms. And so what you see is a movement, according to this argument, from perfect competition to more and more imperfect competition. And this actually relies on neoclassical economic theory, right? That we have a turn toward more imperfect competition with the declining number of firms across the economy. But in fact, if you look at Marx in Capital Volume 3, one of the points that he makes and one of the most important arguments he makes across all of his work is that competition is not a function of the number of firms in a sector. Competition is a function of the mobility of capital. So let me just explain what I mean by that. Competition occurs as capitalists move capital into those sectors where profits are high and withdraw capital from those sectors in which profits are low. So that means the most competitive institutions in capitalism are the institutions that can allocate capital most efficiently, right? That can facilitate the mobility of capital with the least costs across sectors and across space. And large corporations are actually the most mobile, right? They have the most wide range of investment opportunities open to them in terms of where they can move investment as they seek to maximize their profits. Right? They have the most efficient and the cheapest ability to move capital towards where profits are high and withdraw it from where profits are low. Now this happens as these firms pursue new opportunities and divest from operations that are not as profitable. And it also happens within the firm, right? And this is part of what Scott was referring to about the financialization that happened within the non-financial corporation at the height of the golden age. As these companies diversified, as multinational corporations diversified from the 1960s to the 1980s, what happened was all of a sudden the top managers of these firms are looking at the range of businesses in which their corporations consist and they have to decide where they're going to invest the money capital that they own or that they control. Are they going to invest in this division or that division? Are they going to divest from that operation or invest more in it? Are they going to acquire this business or not? And as they do that, these top managers increasingly became money capitalists, right? Investors allocating money capital in a very competitive way across a portfolio of assets that the company controls in the form of its different divisions or different operations, right? So they became finance capitalists in the precise sense that they represent the fusion of finance and industry. So this is just one example of how large multinational corporations, far from being monopolies that are highly uncompetitive, are actually the most competitive, right? They have the ability to circulate money capital competitively across different investments in the most efficient way. So the mobility of capital then increased with the multinational corporation over time, and it increased with the development of the financial system over time, right? Outside the large corporation. The financial system, the development of the financial system, and ultimately the globalization of the financial system allowed for the competitive circulation of money capital in pursuit of the highest profits on a planetary scale. If that marks the decline of competition over time, it doesn't track with my basic understanding of what competition is and how global capitalism works. So the development of the financial system and the multinational corporation intensified competition. This is directly in opposition to arguments such as those made by Baran and Sweezy that we've been living in a monopolistic phase of capitalism in which corporations are effectively command economies of some kind. The fifth argument we try to make is that the state never retreated, right? There's this idea that with neoliberalism, the rise of laissez-faire capitalism, the state kind of retreated from regulation, the state retreated from controlling capital, and just let markets do their thing. In fact, what we show is that precisely as that process of deregulation was underway, what was also happening was the extreme and unprecedented concentration of state power in the Federal Reserve. And the Federal Reserve, of course, is insulated from democratic pressures, right? It's insulated from democratic institutions. It doesn't matter who wins the election to determine what the Federal Reserve's policies are going to be, right? The Federal Reserve makes policy in a way that's relatively insulated from electoral and democratic input. And that's actually key to its success. So what you see is precisely at this moment where we're hearing about deregulation is we're seeing the formation of an extremely authoritarian form of state power that in which basic economic questions and even social questions are increasingly in the hands of institutions that have zero democratic accountability. Right? And that goes hand in glove with what Scott was just describing in terms of the shift from a state that is a tax state allocating revenue, making expenditures based on collecting taxes, to a state that's a debt state, in which the state's finances are financed through the raising of debt, right? That means you're listening more to debt markets and interest rates than you are to democratic input, right? So the state never retreated. The rise of finance came with a more authoritarian state that's more integrated with finance. Sixth, and finally, we try to argue that finance capital is distinct from neoliberalism. Now, Adolf Reed has a really clever definition of neoliberalism. He calls it capitalism without a working class opposition. And I think that's basically right. But the question is, aren't there many potential forms of capitalist class power? Aren't there many potential forms of economic regimes that could exist that have little or no working class resistance? So I think that's right, but I don't think that it gets us specific enough to really understand what's changed. Yes, it's true. Working class rebellion hasn't increased since 2008 in a meaningful way. But at the same time, there have been massive changes in the way that capitalist class power is organized, and especially around the unprecedented, literally unprecedented, concentration and centralization of corporate ownership in the hands of the big three asset management companies, which have displaced the banks at the center of contemporary American capitalism. And the ownership power that is concentrated in their hands goes beyond what we've seen at any other time in the entire history of capitalism, right? So that's a massive shift, which has to be understood as potentially, changing the dynamic of the way that capitalist class power works. But the key point we try to make in this respect is that despite this unprecedented concentration and centralization, we don't see these big three asset management companies becoming command economies. This is not about the controllers of the big three planning the economy, right? Larry Fink calling somebody up and saying do this or do that, right? This is still capitalism, is the key point we make. It's still disciplined by competitive pressures. It's still oriented around maximizing the profits of each individual firm, right? And so in that respect, the basic structural dynamics of capitalism laid out by Marx are still completely hold, right? This has not brought us into a new phase of capitalism whereby Larry Fink is planning out the economy, right? The CEO of Blackrock. So that's really the key point we try to make. And that's very different than a lot of the other takes on the rise of these asset management firms that you see in the literature. So I'm just going to wrap up our little presentation here by drawing attention to what I think is probably some of the most important aspects of this book, which are the political implications that come out of it. And I think they're pretty significant. Really, the book takes on three major social democratic arguments that are made pretty widely on the left today. And for those who might not be aware, when I say social democratic arguments, I mean arguments that are oriented perhaps toward building the power of the working class, perhaps getting us out of the current phase of capitalism by building working class power to enact a range of social programs and progressive measures, but without necessarily seeing the horizon as being socialism, right? Seeing the project of the left as being improving the condition of the working class within capitalism. So I think there's three kind of social democratic arguments that we really take on very directly with the case that we just made, that I just explained. The first is that you see this idea made very often, this argument made very often, that the working class should join forces with industrial capitalists in order to rein in finance, right? It's finance that are the real parasites, not the industrial capitalists. They're the good guys. So what workers should do is team up with their bosses, industrial capitalists, to get control of, rein in, reduce the power of the real exploiters, who are the financial sector. So we want to side with the good capitalists against the bad capitalists. And the former head of economic policy for the Labour Party under Jeremy Corbyn, Mary Robertson, has explicitly told me, and actually when we did a book launch for this book in London at HM, she said publicly that this was what the Corbyn people thought they were doing. That they thought they were trying to create a program that both industrial capitalists, manufacturing firms, and workers could kind of get behind to rein in the power of finance. And of course that didn't work. And it can't work, because that's a project that relies on the assumption that you can craft a pro-working class program that somehow industrial capitalists will also like. Or to say that industrial capitalists have interests that are somehow disconnectable from financial capitalists, which it's not. It's not possible, right? They're completely integrated. So there's no possible social democratic compromise that can be made between the working class and industrial capitalists to restore the good old days of Keynesian capitalism. That's not possible. The second key point we make, I think, in terms of the politics of all this, is that there can be a worker alliance with the financial institutions, like Blackrock, against the industrial capitalists around the environment, like ESG type, environmentally conscious investing, or expanding fiscal policy, right? There is an argument out there that the rise of this new finance capital, or what is often called asset manager capitalism, that it creates the opportunity for workers to team up with the big asset management companies, or to form an alliance with the big asset management companies around expanding fiscal policy, right? That these asset managers are not as vehemently opposed to state spending, including on perhaps social programs, as bankers are, right? But that's also false, right? As we show, the asset management companies have their interests completely tied up with globalization, completely tied up with maximizing the profitability of individual firms, and the idea that they're going to start supporting, fiscal policies to extend, universal daycare or, universal health care, a little bit far-fetched, and at the very least they depend on low inflation, right, as the core of what their interests are. So there's no class compromise with the financiers either around the environment or around fiscal policy. The third social democratic argument that I think we take on is this idea that the main problem with capitalism now is that we need to restore competitiveness, right? This is this Elizabeth Warren kind of argument, that the issue with capitalism is that these big monopolies control everything and they hurt the consumer because they raise prices, and it's a stagnating, uncompetitive form of capitalism, and somehow the working class has an interest in restoring competitiveness. Well, first of all, the working class has no interest in restoring competitiveness, in any kind of competitiveness, right? Competitiveness means intensifying discipline on industrial firms to maximize exploitation. Intensifying competitiveness means disciplining industrial corporations to, pursue deregulation, to eliminate environmental and social protections, to be able to, freely move all around the world in search of the lowest wages, the highest profits, right? That's what competitiveness means. It means workers competing for jobs. It means countries competing for investment. And the idea that that's a pro-working class program should just be, is ludicrous in my mind. But second of all, it is competitive, right? So the problem is not restoring competitiveness. The system is competitive, and we need to actually be finding ways politically to get out of competitive disciplines and to find solidaristic ways of organizing the economy, especially fundamentally, more than ever in the context of the environmental crisis, economic planning. This is the horizon of socialist politics, getting out of the allocation of investment based on competitive market criteria and profitability, and start finding ways to invest, to control investment, to gain control of investment in ways that can be responsive to other social needs besides market criteria like competitiveness and maximizing profits. And that requires taking over the financial sector and finding ways, imagining ways to build the capacities in the state to run the financial system as a public utility, which is what Marx and Engels called for in the manifesto, right? That is the horizon of socialist politics. And then the question becomes, how do you do this democratically, right? We have to take control of the financial system. We have to take control of investment. We have to make it so that investment can be allocated according to social need rather than private profits. And we have to find a way of doing this democratically. And this has become more pressing than ever in the context of the environmental crisis, in which it's just totally clear that capitalist states and capitalist classes, both financial and industrial capital, have no interest in doing anything about the environmental crisis. And even if they did, they have no ability to do so within the parameters of the current system. So we got to change the system. And the way to do that is to start thinking about ways to move toward economic planning. So with that, I can turn it over to discussion. I think we've probably taken up our time.
Okay, thanks very much, Scott and Steve. I realized that I did not actually do what a MC ought to be doing, which is introducing the speakers. So Steve Maher is the assistant professor of economics at SUNY Cortland, upstate, and co-editor of the Socialist Register, and is also the author of another important book that came out in 22, Corporate Capitalism and the Integral State, General Electric, and a Century of American Power. Scott Aquanno is assistant professor of political science at Ontario Tech University and a visiting associate at the Global Labor Research Center at York University. He's also the author of Crisis at Risk, Subprime Debt and U.S. Financial Power from 1944 to the present. I have a question, which I'll take the prerogative of posing in a moment, but I would like to give Jacqueline Cantwell an opportunity to say just a brief few words about a program that the Marxist Education Project is about to launch.
Thank you. Okay, thank you. The MEP Literature Group will start a session on reading Palestinian novels February 22nd. We just finished Chile, reading Chilean novels. The Palestinian session will cover 75 years of Palestinian writing, starting from 1949 to the present. I've brought some of the books in, so after the session, if you want to look at the titles, please do. You can register on the MEP website, and please consider doing it. It's a really nice group. We hold it on Zoom, and people should not be afraid of participating. Some people think it's kind of difficult to participate on Zoom with a literature group, but we do fine. So look forward to seeing you.
Thanks, Jacqueline. So my question is, and I have a couple others which I'll pose later if no one else would like to pose questions, if there's a lull in the conversation. Hopefully there won't be. But if these big three asset management companies own such a large proportion of stock in large corporations, who in turn owns the big three? What can this tell us about the nature and coherence of the ruling class as an assemblage of personnel? And then finally, how much, kind of a related question, how much weight would you ascribe to privately held enterprises that are outside the control of this asset management sector?
You want to take that, Scott? I just talked for ages.
Certainly. So maybe I'll take the second part of the question first, and we'll work our way backwards. So in the book, while the focus is the big three, because the big three control such an enormous amount of money capital and have enormous shareholder enormous influence in terms of their ownership of shares. We also do dedicate a significant amount of attention to private equity firms. And private equity is another form of fusion between industry and finance. In fact, in some ways, it's much more direct, obviously, than kind of the more general forms of intervention that the asset management firms themselves participate within. And so the point here is not to say that asset management firms are the only form of fusion between finance and industry today. Far from it. Private equity firms fall into this constellation. So do activist hedge funds as well, another form of kind of this fusion between finance and industry. The reason we focus, though, on the asset management firms is because of their size, right? Blackrock, the height, I'm not sure exactly what the figures are today, but, upwards of $10 trillion of assets under management, which is, a ridiculous number. And if you control if you include the assets they control within their Aladdin portfolio, it's upwards of $25 trillion of investment capital that they control. The private equity firms, right, Blackstone being, one of the preeminent private equity firms, have a small fraction of that, about $1 trillion, right? So it's orders of magnitude smaller. This is not to say, of course, that that finance capital doesn't take these different forms. They do, but we see private equity firms and activist hedge funds as being kind of part and parcel of a system of finance capital that is dominated by the big three asset management firms. This, of course, is also not to say that the asset management divisions of companies like J.P. Morgan are insignificant, right? J.P. Morgan has built up a large portion of passive, a large kind of passive investment pool, upwards of, 2 trillion dollars. I'm estimating that right now. I don't have the figures in front of me. So other financial institutions are playing a significant role here within the kind of the passive management revolution. But it's just the big three that are kind of front and center within this process. And the book offers, a wide range of data and information on all of that. Now, in terms of the other question about who owns the big three, it's a bit more of a complicated question insofar as Vanguard's concerned, right? Because Vanguard's owned by its shareholders, by the people who own the funds. Blackrock is a public entity, and by that measure, BlackRock itself is owned by other firms as well. And again, I think what this demonstrates is the interconnection between the capitalist class contemporaneously. Do you want to jump in on that point as well, Steve?
Well, I would just say that so I think the key issue is the question of the coherence of the capitalist class. There is no possibility for a split, right? The fusion between finance and industry means that there's no split in the capitalist class.
Yeah.
So BlackRock not only owns all the biggest industrial companies, it's the leading shareholder along with Vanguard and State Street and all the biggest industrial firms. It also owns all the other largest investors. So it also owns, it's the largest shareholder in all the banks. So, there's an interconnection that's so tight and that's the underlying institutional reason why we're arguing there's no split possible that we can see anyway in the capitalist class between financial and industrial firms. So I think that is the key point, the coherence of it all.
Mm-hmm. And just, to build on that point, there's a remarkable coherence between the three asset management firms themselves insofar as, how State Street helps to manage BlackRock's portfolio and vice versa. So there's an integration between the three asset management firms themselves as well. But there's also intense competitiveness, right? And these things can and do go together, and that must be, as we stress, understood.
Okay, are there questions from folks in the room, first of all? I have a couple of questions on Zoom as well, but let me give the mic to this comrade over here. You got to take the mic.
You might have just answered that now, but the point about this interconnection, that industry and finance aren't separable. I think it's very well taken. But any kind of left project that's going to be attacking or trying to take power away from the capitalist class, generally we talk about, okay, there might not, this might be one class, but are there any sort of cleavages? And I remember there was like, there's been talk as like the rise of asset management that these firms care less about inflation than like traditional banking, like where it's like they're dealing with loans and that being like one possibility. And like I said, you might have just answered this like they're like the asset managers own the banks and the banks are investing, so it all ends up being tied together once again. But are there other, accepting that we're not going to cleave off part of the capitalist class as like a supportive element to a program against the other half? Are there things that parts of this interconnected class care about less than the others, where certain avenues of action and political programs to the left, you might have a division in terms of how motivated one part of the class is and gives you more of an opening than something that kind of unites all of them in their hostility?
This is a really critical question, and I'm glad you asked it. I mean, really, I agree with the analysis that's been being put forward by Sam Gindin for the past couple of years, which is that basically right now, the working class and socialists face a polarization of options, unfortunately, which is to say that it's either socialism or a continuation of the current structure of state policy around liberalization and globalization. Because there's no part of the capitalist class that I can see that has an interest in breaking with that, right? Whether it's finance or industry or asset managers or bankers, insofar as the asset management companies are dependent on and have an interest in maximizing the profits of the firms that they own, they have an interest in perpetuating globalization. They have an interest in perpetuating and maximizing the exploitation of labor. They have an interest in managing inflation, even though there is, and in the last chapter of the book, if you read it, you'll see that we have a discussion about the interest of these firms in controlling inflation, the asset management companies, that is. And the truth is it's contradictory, right? At some moments they seem relatively tolerant of somewhat higher inflation. At other moments they're calling for the Federal Reserve. Even before it raised rates, Larry Fink was calling for the Federal Reserve to raise rates to control inflation. So they have contradictory interests. But the bottom line is their main interest is in the profitability of the firms that they own and the competitiveness of the firms that they own. And that depends on maximizing labor exploitation, maximizing profits, ultimately globalization, and ultimately managed inflation. They're not going to be in favor of letting inflation get beyond a narrow bound, right? Even if they have slightly more tolerance than the banks do, who are literally involved in making loans. So the question you're really asking is there an opening? And I'm sorry to say that is created by the rise of the new finance capital. And I'm sorry to say that I think basically what the situation we're in is that we have a need, even in order to enact relatively moderate reforms, the only way of imagining that is to undertake pretty radical confrontation with capital. And so there's a polarized situation, right? We need a radical working class confrontation with capital to even enact mild, moderate reforms, right? I mean, look what Sanders was proposing, universal health care. I'm a huge supporter of universal health care, and I was a huge Bernie supporter, right? But despite how that reform is often framed by some of Bernie's supporters, universal health care was not exactly going to be the death knell of the capitalist system. Right? Lots of countries all around the world have universal health care and they have very well functioning capitalism. Right? There's no reason why the United States couldn't be one of them. But even that reform was too much. Right? They couldn't even get behind Elizabeth Warren. And what was she proposing? Right? So the space for reform, the capitalist class, until there's a much more substantial working class force, it's really hard to imagine there being an opening that's there. And so I think that starts then with recognizing, realistically, as socialist organizers, the challenge that we're facing, which is that there is this polarized situation.
Okay, I'm going to take Christine online next, and then we'll pass it over to Carol here in the front row.
We can't hear it, Ryan.
Can you hear me?
Yes, we can now. Thank you.
Okay. I I wanted to know, to the last point that you made in your talk, how we can democratize economic planning when economics is considered too arcane for average people, average workers, small investors, and managers to understand. So how can we wisely choose representatives to make these economic decisions for us? How can we instruct them in what we want? And wouldn't a public utility that governs economics just become another unaccountable administration unless everyone affected understands the situation and problems at some level? People, like, I'll call it ordinary people, understand social injustice, but they don't. But most of us, and I include myself, don't really understand the system, and so I worry about how this can actually be democratized. Thank you.
Well, the answer is just put us in charge. We'll take care of it. No, that's actually a really, really, really great and very important question. The late Leo Panitch, who was both Scott's and my mentor, used to begin many of his talks with by relaying an argument by the late political scientist Robert Michels, which was the iron law of oligarchy, he called it. And Michels was a conservative political scientist, and he put forward this idea that any organization, based on, by the way, studying the German Social Democratic Party founded by Marx and Engels, that any organization, no matter how democratic, no matter how oriented towards social justice, will inevitably become oligarchic. And that, therefore, socialism is futile. Any struggle for popular democracy or greater democratic engagement by normal people is futile because no matter what organization you build, no matter how many safeguards you construct, it will end up under the control of some kind of elite strata, right? And that was indeed what happened in the Social Democratic Party and the other social democratic parties in Europe. But the way Leo used to frame this is a challenge to us. This is not a foregone conclusion. This is a challenge to socialist activists and organizers to build the kinds of organizations that can prove Michels wrong, that can empower, educate average working class people to understand the issues that are at stake in our society and in our political and economic system, and to themselves become directly engaged in formulating alternatives and enacting alternatives. And that is precisely the most important difference between a socialist organization and a social democratic one, right? The difference between a socialist and a social democratic organization is not just how radical are the policies. The Democrats say they want $15 an hour minimum wage. Oh, well, the socialists want $17 an hour. That's not the difference. The difference is whether you're building the kind of organization that can empower average, everyday people, educate average, everyday people, regular working class people, to become actively involved in shaping the world, controlling their own lives and engaging directly in politics. And those are the kinds of organizations we should be building. And if you don't believe that's possible, then, socialism is impossible. But I am a socialist, and I believe that that is possible, and I remain committed to doing that. And I think that's kind of where we should all begin from.
And really, this is the question we take on in the book, and this is why we write the book. The attempt here is to provide like an accessible understanding of the financial system, is to open up, like, what is market-based finance? How does the modern financial system actually work, right? What is acidification? How did the financial system evolve? How is the Federal Reserve actually involved in the payment systems? How do we understand how the state interacts with the economy and how that has evolved? How do we understand the evolving relationship between industry and finance and the intimate, connections involved there, right? So we're really kind of trying to take on and explain these really important, critically important issues around financialization, which are very difficult to understand. And so in writing the book, we really tried to avoid all of the jargon and get into a deep understanding, an accessible one though, about how the system actually works, right? In order to change it. So it's the question that animates the project, really. And so the easiest answer is buy the book.
Okay, the next question is right here.
Well, you may have just answered this in terms of how we do socialist education for transformation, but I was thinking when you were talking about the stages and the role of workers' pensions in a centralized way, and it's not new. Even at the time that began to emerge, there was discussion about what does it mean that workers are now invested in such a way in this entire financial system. But I guess as the political question then is when people see their pensions at risk, there is an incentive to support the capitalist system and rising profits and rising, stock market and all of that kind of stuff, because we've created a system where we're bought in. So the political question about what that means for organizing workers in a way that seems to them against their own interests.
Absolutely, yeah. That's really also a very important point. Like this is why we have long argued that employee share ownership plans and that kind of thing are totally counterproductive, because what you've basically done is give workers a direct interest in the profitability of their corporations, which is exactly the dynamic they have to break with in order to build working class power. Like the starting point of building the power of the working class, things have to get worse for capital in order for things to get better for labor, right? And the more that the interests of workers become identical with those of capitalists, the harder it is to organize solidaristic forms of worker solidarity and mobilization. So I think that's again the key point about planning and the need to break with ideas that we can have the Meidner plan, this idea that we're going to create inclusive ownership funds, and the state is going to invest in stock, and then it's going to distribute the benefits of dividend payments to working class people, and that's the way that we're going to have social democracy. All of that is counterproductive. For example, the inclusive ownership funds plan I just mentioned, that was put forward by Jeremy Corbyn and John McDonnell in the UK. And it's not clear to me, just to take that example, that it's more radical than a corporate tax. So what have we really achieved here? It looks like, we've got some hand in ownership, but really you're talking about giving people an interest in the success of corporate capitalism. And a corporate tax that finances social democratic programs would be equally progressive, to my mind. So I think workers' cooperatives, inclusive employee share ownership programs, all that kind of stuff, financialized pensions that are invested in stock, those do not represent inroads into a socialist transition, despite how they're sometimes framed. Behind you, Fred, I think there's...
Further questions? Yes.
Thanks. Okay, this question comes from years ago. I used to update the Federal Securities Law Reporter. It was a CCH publication. What I'm wondering is that what information is available to the Fed and these, the big three upon which they base their decisions? How much of that information is publicly available? It used to be that you had to file 10Ks and such. And are those filings appropriate to how the economy has changed in the ways you've described? Because I'm just asking this because I think it's part of an education question. If we're going to educate workers, you have to look at the data available upon which decisions are being made. And is that data appropriate? And how would people learn about it?
Yeah, it's a wonderful question. So I guess there's two sides of it. There's the Federal Reserve side, and then there's the private corporate side. I think one of the advantages, for example, Blackrock has, is its capacity to understand, to manage, and to compute risk. And its massive portfolio and its continuously growing portfolio means that this capacity is always itself evolving. And I referenced Aladdin, which is basically BlackRock's risk management software system, which it sells out to other companies. And it would appear, from the information we can gather, that this does give BlackRock a special kind of glimpse into, how the economy is operating, where the risk is, where it isn't. But this, of course, is proprietary, so understanding exactly how this works and understanding exactly how BlackRock manages its risk portfolio is very difficult to understand. We certainly, of course, can gain an understanding about how much these companies own of other companies, because these have to be reported on, and so we can be very clear about the extent of BlackRock and Vanguard and State Street's ownership of other corporations, and so we can have very strong stats about their ownership share of the 500 largest companies as measured by the S&P and the FTSE 1000 and 3000. So we have more knowledge over those issues, and that's important, right? But it gives, there is, of course, a need to understand these things at a bit more of a detailed institutional level. I think about the Fed too. The Fed is provides a wonderful range of resources. It obviously, updates its balance sheet actions on a regular basis, and also provides a good range of information about its understanding of the economy. But I think one must remember that the Fed's understanding of the economy doesn't just evolve outside of an external relationship to the financial system. Far from it. The Fed is intimately integrated into the system itself, right? In managing short-term interest rates, the Fed is inside the financial system. It's fully integrated into the financial system. And as a market participant, as a market leader, it obtains critical information about how that system operates, which allows it to manage that system in important respects as well. And, all of the specifics of all of that process, we don't know about, other than to say that it's occurring, and the Fed's actions are grounded on its experiences in the financial system, as a market leader in many respects, right? Steve?
Yeah, that's good.
Okay.
Oh, thanks for a great talk. I know you title your book The Fall and Rise of American Finance, and all of your discussion and so forth has really been about the United States, but of course, at the same time, you spent a lot of time talking about globalization and the globalization of contemporary capitalism and contemporary finance. So I wonder if you could say something more about how this works with respect to other parts of the world. I mean, I can think of, there's obviously the EU, of course, the old capitalist economies of Europe. Then also there's the whole BRICS situation, and the very interesting question of the rise of China, which at least purportedly does have a system of economic planning, and within the context of a kind of capitalism. So I just wondered if you could fill out a little bit how you see the relationship between American finance and globalization, as meaning that there is a global, a world of a global economy now.
Thanks very much. Yeah. So clearly globalization is a major factor in the way that the American capitalist class has been made and remade over time. And the American financial system has been the nerve center of global capitalism, and that's a huge part of the reason why it has developed into the juggernaut within the American political and economic order that it has. So there's no doubt about that, but that we're still focusing in this book on the American capitalist class and how the American capitalist class is made and remade. And just because the extent of the American financial system is global, it doesn't mean that we can just generalize from the structure of the American capitalist class everywhere. That said, there is some really interesting research just being done, and I'm not going to run through the main findings or anything like that here, but there is some really interesting research that's come out pretty regularly on the extension of the power of these giant asset management companies into European social formations, into the global South and developing societies, developing states. And so there is a significant extension of the power of these asset management firms globally. Definitely. And that also is a huge part of their position within the American social formation. Those things are completely interconnected. But I wouldn't want to say, same thing with Europe, right? But I wouldn't want to say that, just because we've studied the United States, we understand the world, right? So there is always going to be that. In the case of China, actually, it's kind of an interesting case. There's like one of the largest asset managers in the world is a Chinese state-owned asset management institution. And that plays some role in the ways that economic planning and market competition dialectically interrelate in the unique example of Chinese capitalism, which is also a really interesting case to study, which Scott and I have looked into a little bit. But beyond that, I wouldn't want to say too much.
Hello. I'd like to get your view on how much influence these big money managers actually exert, given that over 2/3 of the assets are passive and not active.
That's a really good question. And we should have touched on that, but we didn't.
Yeah. So this is one of the big questions that, of course, comes up, and we dedicate a good portion of the chapter on new finance capital to this very question. And I think there is quite a rich array of information and data to suggest that the intervention into its portfolio companies is quite staggering, quite significant. Obviously, it's the case that Blackrock, Vanguard, and State Street don't micromanage these companies, right? But if we see finance capital as about micromanaging, then finance capital never existed, right? The J.P. Morgan classical period of finance capital wasn't about micromanaging. It was about more of a generalized process. And that's what we see here as well. The interventions by the big three into their portfolio companies are significant and staggering. And even though they own so many companies, they do take pains to intervene within their portfolio companies on key issues quite regularly. And one only has to look so far as like the statements of the asset management firms themselves, which demonstrate the intensity and extensivity of their interventions into the portfolio firms. Some, of course, more than others, most definitely. So, I think that there is quite ample reason to suggest that the type of generalized intervention that characterized finance capital in the classical period characterizes the present moment as well. It's different, of course, than how it exists with private equity firms and activist hedge funds, most certainly. But it's occurring on a quite regular basis, and it's been institutionalized, the development of investment management branches within the asset management firms whose duty is and goal is to intervene in their portfolio companies.
There's one more point that should be made there too, which is that actually the fact that these funds are passive plays a critical role in explaining why the system formed the way that it did. Which is to say that because these passively managed funds, they can't exit, right? They can't exit from investments that they've made. So because they can't exit, they have to compete by intervening, right? They have to intervene in those firms in order to influence their performance to reinforce the creation of surplus value within those firms, because they can't just cut and run. Right? So they have an interest then in maximizing the value of the assets that they hold, which requires them to play a direct role in influencing or overseeing the strategy of those companies. So these big asset management companies compete primarily to maximize their assets under management. Right? That's their main source of economic value. Right? They want to maximize the amount of assets under management that they hold. And that takes both extensive and intensive forms. Right? They want to own as many companies as they can to maximize their assets under management, and they also want to increase the value of the assets that they already hold. So these companies compete both in order to maximize their ownership stakes across the widest number of firms that they can to maximize their assets under management, and they also want to improve the value of the assets that are in their portfolios. And the only way that they can do that is by exercising strategic guidance over the company's performance that they manage. Now, like Scott said, they're not micromanaging these companies, but they have very extensive investor relations operations that systematically coordinate across their portfolios. Mm-hmm. So,
yeah, as we say in the book, and this point about passive management is critical. And we go over this in great detail, what's passive management, what's active management, how is kind of the passive management, asset management capitalism, as some people call it today, different than the neoliberal shareholder capitalism of yesterday, right? So we go over this in extensive detail. But as we say in the book, lacking the ability to exit, competition takes the form of intervention. And I do think that kind of summarizes the role of the passive investment strategies, right? Organizing the big three asset management firms and other investment companies, within contemporary capitalism. Yeah. Great question.
Yes, I have two questions, which audiences hate, but I'll keep them very brief. First, there's a lot of hype these days about the size and power of the high-tech companies like Google, Facebook, Apple, Microsoft, and of course Elon Musk's companies that took over the third from the last letter in the alphabet. Do they have a place in your analysis? I mean, those are actually the companies that the government is looking at regulating or cracking down on right now, rather than, not the three big asset managers you mentioned. So do they have any place, or are they subordinate to the asset management companies who own some of their stock? That's one question. The other is, I know you're looking for a great socialist program, but I wonder if you find one anywhere, because the problem with all the parties that call themselves socialist or communist or democratic socialist or whatever, they're split into so many little parties and factions that it's hard to find any party really worthy of support. I mean, so who would you support, or do you give up and not answer that question?
If I could just add to the first question, and perhaps to what extent or how can you relate this top subject matter to the debate that's been unfolding between Yanis Varoufakis and Jody Dean and Robert Brenner, et cetera, about the notion of neo-feudalism or techno-feudalism? Is that relevant to this topic as well?
Thanks a lot, Fred. And sorry, I didn't get your name. But thank you for your question. Neil, thank you for your question. I think it's important to recognize that just because we're arguing that there is this fusion between financial industrial capital at the level of management of these firms, and what we're talking about here is corporate control, right? Who controls the corporation? Who controls corporate capitalism? And it turns out there's a hierarchy in which very concentrated owners have a huge amount of say in controlling the management of industrial firms, right? The CEO of those companies, turns out he has to answer to somebody, or she has to answer to somebody. They have a bit of a boss, right? Not in the sense of like day-to-day management of the firm, but they're not the top of the pyramid, right? There's a layer of corporate control, especially now with the formation of these giant asset management companies. There's a layer of corporate control above them. And that's not to say that they directly control those firms every single day, but there's a structure there. And so when you're talking about who controls the corporation, I think that's really what we're talking about. But despite that, that's not to say that the contradictions within the capitalist class are completely eliminated, or that any kind of differences across sectors and different kinds of corporations don't exist, or that these tech companies, in the example that you're using, don't exert a significant amount of political and economic force in their own right? They do. So there's contradictions there. We're not trying to argue that the capitalist class becomes one homogeneous blob that's like a monolithic entity. Right? There's an incredible amount of contradictions and differences across the capitalist class, but there is a kind of organizational structure to the way that that class power is set up, and the top layer of corporate control is in the hands of the largest shareholders in a way that it wasn't. And of course, the amount of control that they're able to exert is proportionate to the amount of shares that they own and the level of concentration that they own. So you can't just run a company, and disregard the people who own 15% of your shares. If you do, you won't be managing that company for very long, right? So that's kind of how we would see that. And in terms of Fred's question about neo-feudalism and political capitalism, Robert Brenner's term political capitalism, I mean, I think Yanis Varoufakis is a very smart guy. I think Robert Brenner's a very smart guy, but I think that argument just doesn't make a lot of sense to me. I mean, it's feudalism. I mean, we have labor markets. We have profit-oriented production. We have, you know, allocation of investment based on profit maximization. I mean, I get that they're making a kind of a cute argument about how the system has changed in important ways, but I think that goes way too far. And it really loses sight of the fact that the core dynamics of capitalism that Marx laid out are very much present and observable every single day and driving our day-to-day reality. And Brenner's thing about political capitalism, I mean, when is capitalism not political? I mean, last time I checked, we do political economy, and that's because capitalism is both a political and an economic order. And the state has always been, from the formation of the Federal Reserve in the early 20th century, if not before, has always been directly and deeply implicated in the running of that system and the stabilizing of particularly finance. I mean, it issues the money, for example. Mm-hmm. I'm going to dodge the question about the small parties. I mean, I think there is a need for there to be a mass politics, right? I think, you know, another small grouplet or whatever isn't the answer. I think there is something to be observed in the fact that these kind of vanguardist formations that you're referring to have never been able to get a significant amount of traction with the working class, and I don't think that they ever will. I think there's a need for a different kind of politics. I was really encouraged by DSA for that precise reason, although, you know, that has its own issues. But, you know, I think there is a need for a mass politics that breaks with both the kind of Leninist and Vanguardist formations that you're referring to, as well as the social democratic parties in Europe, which have been simply co-opted into capitalism and assimilated to those capitalist states.
Yeah. I just think on this neo-feudalism point, just to kind of add to what Steve was saying, I think it comes down to two issues. I think one has to take seriously the relative autonomy of the state, and I think one has to take seriously the role of competition within contemporary capitalism. And competition and the coercive laws of competition continue to exert enormous pressure over accumulation. And both of those points end up pushing strongly against the neo-feudalist arguments, etc.
Thank you. My question relates to how we might go about creating this mass politics that has been referred to, and I'm just wondering if either of you have any thoughts on theories related to the role of family and how that contributes to it. I often participate in these conversations, and it feels like the starting point for who we are starts at the workplace or an organizational meeting, which kind of, from my view, often skips over that people are coming from families.
Well, that's a tough one. You know, I don't know if folks are familiar with the writings of Antonio Gramsci, but one of the interesting things that Gramsci has to say about political organizing is that what he draws on what he refers to as circles of identity, right? So in one moment, I'm a husband. In one moment, I'm a professor. In another moment, I'm a socialist organizer, right? I'm also a son, right? And in all these different moments, I have different forms of identity in which I'm engaged and connected to other people. And I think socialist strategy, socialist organizing, should be aware of that and draw on that. I've been active with the Socialist Project in Toronto, where I lived until recently. And we recently had a guy who we recruited who's a great activist, really sharp guy. And soon his spouse and his children all joined. And I think that's interesting, right? And I think that these connections people have to others can become very political. And I think understanding how that happens is part of what organizing is about.
Yeah, and I just think, one has to be aware of the enormous discipline that workers face and the effect of that on the family. And and be able to just come to grips with that and be aware of the wide-ranging impact that profit-driven accumulation has on the family, and to take those pressures seriously. And in a sense, that's really what we're trying to get to in the book. It is outside the purview of what we're doing, but of course, it's always in the background of how we're conceiving these issues.
Okay, maybe I'll pose the last question. The Marxist Education Project, as some of you may know, organizes classes and study groups on Marx's works of political economy, on Capital, Volume 1 and Volume 2. We just finished a long reading of the Grundrisse. We're currently embarked, the same group's now reading the Theories of Surplus Value. So we are interested in learning more about how Marx's ideas can be applied in the real world at the present time. And an undercurrent of a lot of what you've said today, strikes me as having been in the background, or in the underlying it is an understanding of Marx's work on the credit system, on different forms of distribution of surplus value, and so on. So I wonder if you'd just be able to speak a little more to how and to what extent your work has been informed by reading of Marx.
It's a good question, Fred. Yeah, so I mean, definitely anybody, when you read the book, if you read the book, I hope you read the book, you'll notice that there's a very large number of citations to Marx's Capital Volume 3, and a significant number of quotes from that book as well. And I think one of the things we did try to do in this book is, in a very accessible way, to kind of draw on Marx's theories of money, credit, and finance. There's fragments in Volume 3. It's really quite fragmentary, but we really try to draw on those fragments to pull them together into a coherent sense of a theory of money, credit, and finance. And that is something that's kind of in the background of the book. And we also use it as a kind of empirical framing for the way that capitalism was developed was developing in the 19th century as a kind of prelude to the main drama of the book that we wrote.
Mm-hmm. And I think we show the way in which a careful reading of what Marx is saying in Volume 3 it really helps us to understand how the financial system works today, and that there is really a lot there that can, really shed light on how finance works and the precise way in which finance actually contributes to accumulation and competition. And, I think our reading of Volume 3 really shows how, this idea that finance is parasitical on an otherwise, healthy industrial capitalism, is problematic. At least, again, our reading of that in Volume 3. But I think so much of our analysis was inspired by, a very careful reading of some quite difficult chapters in an unfinished, sprawling manuscript. But there's, I think, a lot of good there. And I think one really has to, I think returning to that is important, and continuously building it up and drawing inspiration from that. Certainly our theory of competition is built out of that, and the theory of competition and the mobility of capital and the role of finance and credit markets and money markets in supporting accumulation and disciplining accumulation. All of it has its foundations in Marx's analysis in Volume 3. And so, Chapter 2, be warned, is a bit of a difficult read at times, but we really try and break this down and demonstrate the usefulness of Marx and Marx's work in understanding the contemporary financial system.
So the theory of competition that we laid out is straight out of Volume 3. In fact, that's the centerpiece of Volume 3. But it also needs to be said that people have adopted Marx's theory or his statement about fictitious capital to damaging effect on their analysis. Cedric Durand's book, Fictitious Capital, draws on an interpretation of Marx's theory of fictitious capital to make precisely the argument that we're challenging. And I think if you actually look at Volume 3, it's really not what Marx is saying. Marx is really aware of how functional finance is to accumulation, the role of the development of the credit system and the financial system in intensifying the mobility and competitiveness of capital and in fueling the expansion of accumulation, right? Of course, with all the crises and contradictions that come with that. But I think, yeah, so as much as we draw on Marx, I think it's also the case that one has to be, aware of the fact that, Marx himself has the theory of fictitious capital is not one that I would take on, at least using that language.
Okay, thanks again to Steve Maher and Scott Aquanno for this. Yes.
Thanks.
And we look forward to seeing everyone at future Marxist Education Project events and study groups. You can go to marxedproject.org for all full information. And buy the book, read the book, talk to your friends about it. And thanks especially to the People's Forum for hosting this. We look forward to further collaborations between the MEP and the People's Forum. Thanks again.
Thanks a lot, everybody. Thank you very much.
Thank you.